In the 1980s, there were over 18,000 banks in America. Today, there are only 4,700, and they are expected to continue to decrease over the next 37 years. Despite this significant reduction, the United States still has 10 times more banks than other countries. For example, Canada has only 35 banks. France has 337. And the United Kingdom has 344. This leaves room for further mergers and consolidations among American banks. If the current pace of 117 mergers per year continues, it will be another 37 years before the number of banks in the United States approaches the levels of other countries, which typically range from 300 to 500 banks. The primary reason for this simplification of the banking system, where smaller institutions are cut and medium-sized ones are consolidated, is the high cost of maintaining the traditional network of banks that provide credit and money movement services across the country. Recent policies of the American Central Bank have worsened the situation. The reverse repo is a service where a bank can borrow Treasury bonds from the Federal Reserve with the promise to return them at a higher price. These borrowed securities help banks manage their liquidity reserves and meet regulatory requirements. However, for the Fed, these operations are a cost, as it must repay the counterparty at the agreed interest rate and the principal amount at the contract's maturity. In addition to the reverse repo, there's the Bank Term Funding Program, BTFP, established after the recent banking crisis, in which the Fed commits to buying Treasury bonds from a bank at full price, not market price, to cover any budget shortfalls. Why is the Fed willing to bear these costs? It seems that the Fed is willing to absorb these rising costs to ensure that banks can provide loans to individuals and businesses. The exodus of depositors from small banks to large banks and money market funds has reduced the liquidity necessary for these banks to provide loans. If loans contract, the economy gradually slides toward recession. So, it makes sense to think that the Fed wants to preserve credit lines to individuals and businesses, which generate new money to kickstart the economy. On the other hand, the Fed has just completed its fastest and most aggressive interest rate hike and state bond reduction program in history, with the opposite goal of slowing down the economy. So, is the Fed afflicted with schizophrenia, boosting the economy during the day and slowing it down at night? Or is it working through trial and error, aiming to maintain the economy in a precarious balance? Perhaps the central bank has a different purpose, a plan whose outlines are only partially visible now but will become much clearer in the future. The Fed's true purpose: creating a market-steady Treasury bond class. We can get closer to understanding the Fed's true purpose by observing its new Treasury bond lending service for central banks of other countries. With the new daily swap lines in US dollars, established after the recent banking crisis, the Fed began lending Treasury bonds to foreign central banks at face value, not market price. These central banks can then borrow US dollars from financial institutions in their countries in exchange for these bonds, essentially a service similar to the American reverse repo. Although this service has been used only once so far to support Credit Suisse's default, its mere existence indicates that its purpose is not so much to support foreign bank defaults but to prevent non-US financial institutions hit by sudden crises from selling large amounts of US Treasury bonds to raise liquidity. Why would central banks worldwide distribute US bonds valued at $1,000 to their troubled institutions, even if they are only worth $800? The reason is simple: to prevent the entire house of cards from collapsing. The Federal Reserve and central banks of friendly countries are simply removing the duration risk and liquidity crisis from US Treasury bonds. Ultimately, what the Fed is doing is a large campaign to stabilize US government bonds. These new national and foreign credit lines, collateralized by market-steady Treasury bonds, are not affected by the Fed's monetary policies. However, there is a peculiar dilemma: why is the Fed, on the one hand, implementing monetary policies, including some very strong ones, to achieve specific effects on the economy, such as inflating with K and deflating with QT? And on the other hand, creating credit lines where these effects are null? If these credit lines were used not only by banks but throughout the credit system, they would render the Fed's efforts to create deflationary or inflationary effects with its policies ineffective. In essence, they would make the Fed itself obsolete. So, are these credit lines intended to be used only in specific cases by a select group of operators, or is there more that we don't know? Does FedNow have something to do with all of this? Those within the FedNow network, especially banks initially, will be able to send/receive money in seconds with almost instant settlement. This is the new payment service that the Fed intends to launch between June and July. From one perspective, FedNow seems designed to make the Fed's control over banking defaults, which the Fed itself has triggered with its monetary policies, even more efficient. Instant payments could allow massive real-time liquidity injections from the Fed. With FedNow, the two tools the Fed has already put in place to rescue banks, the rarely used discount window and the aforementioned Bank Term Funding Program, could be implemented much faster, canceling out the destructive effects of any bank run, regardless of its size. However, FedNow might also serve another purpose. The secret purpose of FedNow. Before exploring this, let's establish one thing. FedNow is not a CBDC, a digital dollar. We're not talking about a tool for conducting digital dollar payments or transactions. FedNow is simply a platform for buying and selling Treasury bonds from the Fed, nothing more. This platform, if shared with a sufficient number of operators, institutions, and companies, could be used for a widespread promotion of Treasury bonds to turn them into investment assets competing with more well-known options like stocks, gold, or cryptocurrencies. Efforts to stabilize Treasury bond prices and yields could be the essential prerequisite for making these bonds an attractive investment asset for the Fed. Investors currently prefer Treasury bonds due to their higher yields compared to regular bank deposits, which has been pushing capital away from banks. If a separate class of these bonds, one shielded from market fluctuations, could be created, it might become a permanent choice for investors, even if it's at a lower yield. So, is this the undisclosed goal of the Fed? We can't say for sure, but one thing is certain: a bond guaranteed by the Fed with a stable 4% to 6% return, easy to use, agile, and with lightning-fast exchange capabilities on the FedNow platform, could pose a significant challenge to cryptocurrencies, especially when it comes to yield. Cryptocurrencies have an extraordinary capacity to multiply their value by 1,000-fold, but for most other uses, they aren't competitive. Even the fastest and most scalable cryptocurrency is much slower when compared to the FedNow platform, which doesn't even use blockchain technology. Decentralization reduces transaction speed and scalability, as well as economic efficiency, which is a fundamental characteristic of blockchain. There will likely never be a cryptocurrency capable of competing with the highest level of centralization, like FedNow. And if one were to emerge, it wouldn't truly be a cryptocurrency but rather an imitation. Therefore, in envisioning the future realistically, we must set aside our biases, dogmas, and prejudices and consider even the elements we may not favor but that possess potential equal to or greater than our preferred cult objects. In conclusion, banks, CBDCs, Treasury bonds, FedNow, cryptocurrencies, DeFi, and fiat currency won't eliminate each other, at least not right away. Instead, they will coexist in competition for a considerable period without clear winners. Thanks for watching.